Govind Chellappa, MD and Head of India Research at Jefferies India, joins in right now with his thoughts on the markets. Govind, hi, good morning. Good to chat with you today. What is your sense? We've been talking ad nauseum about how the currency ban is going to actually impact consumption, earnings, the GDP, markets, what have you. What is your guesstimate of how long lasting the impact of the note ban could be on A, earnings, and B, equity markets?
Yeah, to start with, I'd say that the expectations for earnings growth for the current year and next year and beyond was quite high even before the November 8th announcement. And the November 8th announcement obviously makes it tough for those expectations to be met. Now, put in context, the last 5 years, the index earnings growth has been in low single digits, and as we speak, consensus expectation for FY17 is 12-13%, and for FY18 is anywhere between 18 to 20. To expect FY18 earnings growth to be the highest since FY11, given all the transition that we are going through, both in terms of demonetization, which I see as a larger part of a larger process of anti-corruption, as well as GST transition next year, I think it's a bit too optimistic. So we are looking at some severe cuts to expectations, especially for the domestic focus sectors for the next couple of years. And on those on those expectations, valuations aren't really cheap. So I think the markets will struggle for a few months. Of course, there will be extraordinary volatility in the next few months because we are in uncharted territory. But having said that, I think over a 1 year period, I would be fairly cautious on both earnings as well as markets.
So aside of that, Govind, I mean, from an investment perspective purely, what is the right approach, say, for the next 1 year to come? Tactically, how would you allocate money within various sectors, assuming that, consumption, etc., are bound to get hit because of the currency ban?
Okay, so as I mentioned, I don't see currency ban as a single event. It's not an isolated event. It's part of a political process of the current government's positioning being against corruption. I think the only plank on which the 2019 elections will be fought by the Modi government will be on success or otherwise of against corruption. Uh, to be honestly looking at the situation, the fact is there is hardly anything the government can do to improve growth in the kind of global economic environment that we are in. And added to it is the severe employment challenge that we have, and I think that's getting from bad to worse. So to fight the 2019 elections, this is pretty much the only plank, and I think therefore you will see more and more such efforts going into the next couple of years. So we have to assume that this is one of the several steps that is being taken by the government and that it will continue. And if you put things in that context, the slowdown that you might see in consumption, especially consumer discretionary demand, could last much longer than what people think it will. And that's been the flavor of the last 2 years. I mean, the last 2 years, the markets have been predominantly about consumer discretionary as well as financials that are focused on consumer discretionary. And I think investor position has to change. On the other hand, having gone through this process of anti-corruption, the government has involved almost all citizens in this process. They've inconvenienced most of the populace, and people have seem to be more or less largely supportive of the current drive. But in the end, people have to see some tangible benefits. So what I expect over the next 1 year is fiscal spending that is focused on the people at bottom of the pyramid, and a subtle shift from consumption from discretionary to staples. So there has to be rebalancing of portfolios towards low end consumption, that is primarily in staples, and you would find a few other sectors which are independent of these events, probably the IT sector. I also expect a big recovery in demand for housing probably a year down the line if real estate prices come down to the extent that all of us expect and rates remain where they are. So you could see opportunities in suppliers to housing. Developers don't benefit because prices come off, but I think you could play this through the cement sector. So long story short, we are looking at markets struggling over a 1 year period and a need for a massive rebalancing of portfolio away from things that have worked very well in the last couple of years, which is NBFCs, consumer facing financials as well as consumer discretionary, towards IT, towards consumer staples, towards some cement stocks, etc.
That's interesting. Trigger-wise though, Govind, I mean, aside of this, what are you feeling about the global landscape? Soon we're going to have the Italy referendum decision as well come by. You're still to have the Fed actually take a call on whether or not they want to hike interest rates, and if so, by how much. And Trumponomics continues to be a big question mark as well. How are you assessing the global setup right now?
Well, we are in a peculiar situation of global cost of capital going up and cost of capital in India coming down, right? I mean, that seldom happens. If you see the interest rate differential between India and let's say US, it's narrowed quite significantly. But if you look at the inflation adjusted interest rate, if you look at real interest rate difference, that hasn't adjusted much. So to that extent, I think we still have room for interest rates in India to go down, even though global interest rates go up. So while there is so much focus on yields in the US going up and therefore its impact on valuation, what we have to remember that is that cost of capital in India is coming down in this environment. Secondly, I see the global environment for developed markets being fairly steady. We don't expect any on the balance, you could see some acceleration in fiscal spending in the US, some stability in Europe and Japan, while emerging markets continue to struggle. So if you're looking at export basket of India, the services sector should be fairly okay. I don't think that you'll see a massive acceleration, but I don't see a massive deceleration either. But export of goods would remain challenged because exports of goods from India, other than textiles, is mostly to emerging markets. Especially engineering goods and auto products, and I think they will struggle for some time to come. So it's a mixed picture as far as the global environment is concerned. I'm not worried about yields affecting valuations here, but I do worry about export demand, especially for manufactured goods.
Okay, Govind, good morning, Neeraj here. I heard you mention in your earlier answer that while consumption remained the stronghold, investors will now need to rebalance their investment approach. So now my question to you is this a measure for the next 1 year? And if so, what do you recommend people do? Because investment cycle technically doesn't seem to be like picking up in a hurry. So what do people do? And or is this essentially for a long term and therefore you're moving out of consumption completely for the time being?
Okay, so I'll look this in three different baskets, right? First, on consumption, I'll split into low-end consumption and consumer discretionary. All the anti-corruption move impacts luxury consumption the most, and it impacts staples the least. Though the transition process probably impacts staples and two-wheelers a lot more than it impacts cars and other discretionary items. Post the transition impact, once currency in circulation is normalized, let's say 6 months or 9 months down the line, the wealth impact will have a lot more negative impact on consumer discretionary spend. At the same time, I think the fiscal spend will be weighted towards low-end consumption, and therefore consumer staples could accelerate. So within consumption, it's not a blanket call. I would think there will be some slowdown in discretionary compared to what we thought earlier, and there could be some acceleration in low-end consumption. So that is one adjustment to be made. As far as investment is concerned, see, private investments have been notable by absence, and I think that stays that way for at least a year or two more. If at all the events of the last few weeks postpones private sector capex by a few more quarters, if not longer. Infrastructure spend by the government could accelerate a bit, but remember that we don't have the institutional capacity to accelerate it massively. So even though fund availability might improve, I don't think the implementation can improve massively. Having said that, the delta on capex could be slightly positive if the government decides to allocate a little more funding. So it's finally boils down to the risks on the three segments. Consumer discretionary, I think the risks are on the downside. Staples risks are on the upside, and on investments it's balanced but probably slightly to the upside.
The leg to the market then, Govind. I mean, IT doesn't seem like being a strong enough leg for the market to stand on. Banks is arguably one space where the opinion is divided here. You saying consumption is out of the window right now. If at all staples, which are not exactly cheap, are going to set the stage on fire, I would believe, the likes of HUL or some of the others. Or at least that's my belief. Yours may be different. What's your thought? What are the legs for the market? What's your 1.5 year, 2 year, for a lack of a better word, target on the market?
Well, I'd be very surprised if the market is significantly higher in a year and a half time. What I do see is somewhere in the next 1 year, the market's being, down by high single digits or 10% maybe 6-9 months down the line. But I don't see much returns in the markets over the next 1.5 years. So all the comments that you made are absolutely true. First, the market isn't cheap. There aren't too many sectors that are cheap. There aren't too many sectors that have the right combination of risks and rewards, and that's the reason I would say that the markets would struggle. So what we are looking for are stocks that would do well in an environment where the overall markets struggle. And by definition, what we are looking therefore is for low single digits or low double digit returns. We aren't looking at sectors hitting it out of the park. Staples are steady sectors, valuations are not cheap, but if earnings growth is in low teens, I think that's the kind of returns that you would get. Same is the comment I would make on the IT sector. On financials, our view is that while there are some limited positives of higher CASA, the fact is you're looking at probably slightly lower credit growth over the next 1.5 years compared to what you thought earlier, and risks on NPLs. And valuations again, especially for the well-run banks, aren't cheap. So I don't see that leading the market either. So in conclusion, I'd say that we are looking at a market that will struggle, and some sectors which will outperform and it will eke out high single digit or low double digit returns. But we aren't looking at too many stocks or sectors that will give you the kind of returns that we have seen in the last couple of years.
Govind, a lot of people are looking at that 1st February date to, for Modi to actually come out and announce perhaps a bounty, or the finance minister, I should say. What is it that you're expecting from the budget? Because, there are just so many rumors and speculations that the budget is going to throw in a whole lot of bounties for all the sectors getting impacted because of the currency demonetization. Largely, what is your assessment on what we could hear from the finance minister?
Okay, first let us set the context. It has been impossible to predict what the government does. I think that's been the feature of this government. Now, 3-4 weeks back, if you'd asked me what is the biggest anti-corruption move the government could do, there's no way I would have said demonetization. So that's the first thing. Secondly, I agree there is a lot of speculation on what the government would do, but remember that FY18 also, as things stand, will also have GST being implemented. So for any of us to do the math on what the fiscal could look like in FY18, it's an extraordinarily challenging period. What we are looking at is some upside to direct tax collections, personal direct tax collections, but reasonable downside to indirect tax collections as well as corporate income tax collections. And in the context of an economy that will be slower than otherwise. So in that context, it's hard to put a number on how much of money the government will have to spend on reflating the economy. The only comment I'll make is that any reflation will have to necessarily come through with a benefit for people at the bottom of the pyramid, because that's a political need, that's also the economic need. I mean, if you want to reflate an economy in the immediate short term, the best way to do it is through wealth transfer. Capex has a much higher multiplier effect, but that takes time to take effect. So if the government is looking at reflating the economy in FY18, it has to focus on low-end consumers, it has to focus on people at the bottom of the pyramid. What form or shape and quantum it will take is impossible to predict as of now.
Yeah, the hopes all pinned on what is actually going to come about in this budget. But Govind, great speaking with you. Thank you so much for taking the time out and joining in.
Thank you.
Well, that's the view coming in from Jefferies India. And the markets, where are they? Well, just slowly creeping up from that 8150 mark. 8172 is where we're currently at, still holding on to that 1% gain for the broader markets.
You can watch live TV on our website mpnow.in. Find us on Facebook at facebook.com/magicbricksnow. And don't forget to click the like button. You can also follow us on Twitter at magicbricksnow. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/magicbricksnow.